very heavy unemployment, very close to 10%. We don't have the financial cushion that we've had in prior times, in prior recessions. It doesn't take a rocket scientist to figure that the logical remedy for households or business is, from this weakened condition, is to earn as much as possible and to save as much of our earnings as we possibly can. We've got to repair our balance sheets. How's the government trying to solve the problem? Ironically, the government, the monetary authorities, are trying to solve the problem of too much debt and too little saving by encouraging more borrowing and a lot more spending. They're providing us tax incentives to buy more houses. They're providing us tax incentives to buy automobiles. They're encouraging us to get out there and to spend. We don't know how the crisis will ultimately be resolved, whether the government will win or the government will lose, but the precedents aren't very encouraging. If you look over to the next page, this one takes a little work. We'll talk about it a bit. And no analogy is perfect, of course, but what we see here on page 32 has a lot of distressing similarities. First, what are we looking at here? We're looking at the Nikkei 225, so that's one of the major Japanese stock market indexes, and the S&P 500, say real overlay. Real simply means they're doing an inflation-adjusted number. So they're inflation or deflation adjusting. What they've shown you is if we match the real tops of those two stock indexes, the Japanese and the S&P 500 at the 0 years level, we go back then 20 years, and then we go out in forward 20 years, at least in the case of the Japanese market. And there are some very interesting parallels. No analogy is perfect, but you can see we went to that peak pretty much in sync with one another over a period of 20 years. We have come down in a remarkably similar fashion. We didn't come down quite as far on the initial burst. This would have been 2000 to 2002 or 3 for us. This would have been 1990 through about 92 or so for them. Our biggest rise was more than theirs, but we made up for it with the next decline, so we're down in the same general neighborhood at roughly the same time frame. If we, in fact, also were showing on this graph the NASDAQ, that would have gone down to about here, and then a bounce up to here, and it would have been down in here somewhere. So if you combined, let's say, our NASDAQ and our S&P 500, we would be even closer to that Japanese line. Now, an analogy works until it stops working. So you have no way to say that because these are pretty similar, this will be the same. We hope it isn't. I mean, here we are. Japan has got a couple more months to finish 20 years from this peak, and they are still down 75% from where that stock market was at the end of the 1980s. So it was right on the last trading day in 1989 that it reached that peak. So if you look then up into this box, will the current U.S. deflation, now in its 7th month, we actually have been in a deflationary trend for 7 months, become a chronic problem as it has been in Japan through much of the last decade. Now if we go down to here, this green shows the inflation rate on this scale over here for Japan. You can see it had some substantial inflation back in that period around 1975, as did most of the world. We did here too. We had very severe inflation. It came down, and from that 0 line, it has degenerated into a period of more deflation than inflation in those out years. We have just, at this point in time, dipped into deflation. Admittedly, not for long, 7 months so far. But it's not at all clear which way we're going to go. And I'll talk just a little bit more about that in the next couple of minutes. But in fact, maybe bring it in right now. The inflation and deflation question is certainly one of the most important both economic and investment questions to deal with. And it is one of the things, some of you I know from comments from you have tuned into the blog that I'm posting once a week at least. I'm trying to do more than once a week. Sometimes it's a struggle to get one a week in. But if you do appreciate these gatherings that we have relatively infrequently, and I'm trying to put something up there by way of some kind of market or economic analysis at least once a week. The blog site is thomasjfeeney.com, no period after the J, and take a look, see if it's something that is of interest to you. I will be doing a piece on the inflation-deflation question, but let me just kind of do a very quick summary right now because I think it's very much tuned in and part of what we're dealing with right now in this question of what kind of investments will we be looking at over the next weeks, months, what have you. And with the monumental amount of monetary stimulus that Susan was profiling before, that's been injected into the economy, it's logical that many people are worried about the possible effect of inflation. All else equal, you put that much new stimulus into the economy, you're going to very likely see an inflationary result. At the same time, as Susan showed on that graph on page 6, the cash being funneled into the banks is not being cycled through the economy. The cash is being held as reserves. And that was that line, if you remember, the line that went way up and just kind of plateaued up there in terms of bank reserves. And it's not inflationary if it's just sitting there. You could put more and more and more money in there, and if it doesn't go anywhere, it's not inflationary. It's got potential to be inflationary if it is cycled through the economy. But if it's just held in the bank, it's not inflationary. Now, that could yet happen. I mean, it could be that the banks will start lending that out and it will start churning through the economy, and inflation could occur, and it could be substantial. And always keep in mind that inflation is also the most politically expedient way to emerge from an over-indebted situation. That's the way, inflate it away. That's been the pattern of over-indebted countries for time immemorial. So it's certainly a very real concern. And it may happen yet, and inflation could in fact be severe. But on the other hand, I would suggest that the more immediate problem is potentially deflation. The reduction of debt, either willingly or unwillingly with foreclosures and so on, or loans not being rolled over, is inherently deflationary. And that's the deleveraging process that everybody is hearing so much about, which is likely to go on for a few more years at least. So what do you do then if you're faced with those alternatives, inflation or deflation, from an investment perspective? Investments likely to benefit from inflation, traditionally people say equities, and that's probably true as long as the economy is sound and inflation is not too robust. Precious metals, very likely, would benefit from inflation and would probably benefit a lot from hyperinflation. Other currencies would probably benefit inflation to the extent that they are not exposed to, in their own countries, to the same level of inflation. Ironically, and I, for the life of me, I can't put my hands on this study, which I remember reading years and years ago, written by a German who was then living in La Jolla, California, and has since died, and I don't remember his name, but I remember having read this many times over a period of 20 years, 15 years at least, and I can't find it and don't remember what his name was or what its name was. In any case, he did a study of the assets that did best during the 1920s in the Weimar Republic's explosion of the currency, where the German mark, the old mark, went down to be worth absolutely nothing. And he found equities did reasonably well, holding maybe 75% of the value of the currency, but that's still a minus 25. Ironically, the one asset that held up best in that time